Depreciation, again, is all about the matching principle, matching the expenses to the revenues that they helped create. So if I buy an asset that's a 10-year asset, it's going to be helping contribute to my revenue for 10 years. Therefore, I want that expense to be spread out over that same 10 years. That's what I mean by the matching principle. All plant assets except land are going to be depreciated. The factors that we need to consider in here would be the capitalized cost. That's what you figured out in the first part of the chapter, where you could include anything that was required to get the asset there and available for use. So that total net cost that you recorded in the first part of the chapter. We also need to know the estimated useful life. That could be in years, or it could be in usage like miles or machine hours or something like that. And we'll also need to know the estimated residual value. This is also called the salvage value sometimes. It's what you think you're going to get for it at the end of the asset's life. So we know the capitalized cost at the top. We have to estimate the useful life and the residual value. Another term that you'll see here is the depreciable cost, and that is the capitalized cost minus the residual value. That's an E, sorry. Oops. So what I paid for at the beginning minus the residual value, that's how much I'm going to depreciate. So that's going to be the depreciation basis. So let's talk about our three different methods. We have straight line, which is where the depreciation expense is spread out evenly over the life of the asset. We have units of production, and this is a two-step process. We allocate it based on the use of the asset, not just the life of it. And I'll show you an example of that one. And then we have the double declining balance method, which is an accelerated method. The book also mentions MACR, M-A-C-R, Modified Accelerated Cost Recovery System. That is an IRS one, and they don't go through it too much in this book, but basically the IRS says, this is how much you can depreciate each year for this asset. So I'm going to use an example in here, and I believe this was the example in the book. I think that's where I got this one. I buy a truck that costs $41,000. That's the cost of the asset. It has an estimated residual value of $1,000. So at the end of its life, I think I can sell it or trade it in for $1,000. So the depreciable cost is $40,000, and the estimated useful life is 5 years or 100,000 miles. So I'm going to show you all three methods using this exact same example right here. So kind of remember those numbers. So for straight line, I just take the cost minus the residual value divided by the estimated useful life. And that's going to give me my depreciation expense. So in this case, the cost was $41,000. The residual value was $1,000. and the useful life was estimated at 5 years. So I'm going to take that depreciable cost of $40,000 divided by 5 years, and I get $8,000 per year is my depreciation expense. And I'm going to do that every single year. Another way you could look at that is you could take 1 over 5 years and you get 20%. So each year I'm going to depreciate 20% of that depreciable cost. So I'm going to take 40,000 times 20%, and that's 8,000. I'll show you when we get to the double declining. You'll understand why I kind of explained it that way. But I want to show you what's happening when I depreciated them. Okay, so at the end of each year, so I'm going to do year 1. The cost of the truck was $41,000. The accumulated depreciation. So each year I will debit depreciation expense and credit accumulated depreciation. Remember, that's all the way back in chapter 3 for $8,000. $8,000. Okay, and I'm going to do that every year for 5 years. So the accumulated depreciation after year 1 will be $8,000, right? So the book value of the asset will be the cost minus accumulated depreciation, so that's $33,000. In year 2, the asset on my books will still be at $41,000. It stays at that cost. But the accumulated depreciation, I'll add another $8,000 to that. So that'll be up to $16,000. So the book value goes down to $25,000. 41 minus 16. In year 3, the truck is still sitting on my books at $41,000, but now I've done that $8,000 3 times, so the balance in accumulated depreciation is $24,000. So the book value is now down to $17,000. So accumulated depreciation keeps going up, and the book value keeps going down. The cost, the asset itself, doesn't change at all. So in year 4, the truck is still in there at $41,000. Accumulated depreciation's been $8,000 4 times now, so that's up to $32,000, and that brings the book value down to $9,000. And then in year 5, the truck is still at $41,000. Accumulated depreciation is up to $40,000, and the book value is down to $1,000, which matches that residual value. I keep depreciating, so at the end of the depreciation, the total in accumulated depreciation should equal the depreciable cost, and the balance, the book value, should equal the residual value. So that's what it looks like under straight line. The depreciation expense is the same every single year. And in all these methods, I'll get to the same point. I just don't spread it evenly over the life of the asset the way I do. So let's do units of production. We're going to use that exact same example. This one's based on use, though, not life. And so, therefore, it can vary each year. So we have kind of a 2-step process. The first step is to come out with a depreciation per unit. So the per unit depreciation is going to be the cost minus the residual. And then I'm going to divide that by the estimated usage. So in this case, the $41,000 cost minus a residual value of $40,000. And I expected to use this one for 100,000 miles. That's how long I expected it to last. So I get a rate of 40 cents per mile. That's kind of my depreciation per unit. Then I apply that per unit depreciation times the actual usage, or I think in this book sometimes they say estimated, but just how many miles if it's a truck that they drove it that year. So in this example, in year 1, my usage, my actual miles driven, was 20,000 in year 1, and this has to be given to you. In the example in the book, they gave you this, but this would have to be given to you. Times that per unit rate, so in this case that's 40 cents, will give me my depreciation expense for year 1, which is $8,000. So then we could do kind of a similar thing here. Accumulated depreciation, and then we could also calculate our book value. So in year 1, my depreciation expense was $8,000, so that means accumulated depreciation is $8,000. The book value is always going to be the cost minus the accumulated depreciation. So 41,000 minus 8,000, I have 33 in there, which is actually the same as what I had under straight line. In year 2, the actual usage was 24. I'm sorry. Yeah, what do I have in there? Oh, sorry, 30,000. I'm looking at a different problem. 30,000 miles times 40 cents means my depreciation expense in year 2 is 12,000. So my accumulated depreciation, in the first year I put 8,000 in, the second year I put 12,000 in. So you add them together and your accumulated depreciation is up to 20,000, which means your book value is down to 21,000. In year 3, I drove the truck for 25,000 miles. Times 40 cents a mile gives me depreciation expense of 10,000. So I add that, and so accumulated depreciation will be the sum of these, or what I had before, plus what I just added. So the 20,000 plus the 10, that's up to 30,000, which means the book value is down to 11,000. In year 4, I drove the truck for 15,000 miles, times 40 cents a mile, so depreciation expense is 6,000, which brings my total accumulated depreciation up to 36,000, which brings the book value down to 5,000. And in year 5, I drove the truck for 10,000 miles, times 40 cents a mile, so that's $4,000 is the depreciation expense in year 5. Add that to my previous accumulated depreciation, so total depreciation is up to 40,000, and the book value is down to 1,000. So I end up at the same place. It's just instead of spreading it out evenly 8,000 a year, I've got different amounts each year. That's units of production, which is also the exact same way you do depletion when you get to the natural resources. Okay, one more method here, the double declining balance. So each of these words means, so double means you take the straight line percentage and you double it. So in this case, if it's 1 over 5 years, which is 20%, you double that and get 40%. Okay? So if it was 1 over 10 years, that would be 10%. You double it to get 20%. So double the straight line rate of a declining balance. So the declining balance is the book value. Remember how we said here, the book value keeps going down? That's that declining balance. So you will always take double the straight line rate and take that percent times the remaining book value to get the depreciation expense. So in this example, I will always take, I'll always take the book value times 2 times the straight line percentage. And the straight line percentage is 1 over the years of the useful life. And the book value is always the cost minus the accumulated depreciation. So in this example, I'm going to do, year 1. The book value before I've done any depreciation is 41,000 times double the straight line rate. So in this case, that did that 1 over 5 equals 20%. Double that to get 40%. So each year I will take 40% of the book value. So that gives me depreciation expense in year 1 of $16,400. That's the book value times 40% gives me depreciation expense. So then, if we need to keep track of this though, the accumulated depreciation at the end of year 1 will be the $16,400, and the book value will then be the cost minus the accumulated depreciation. So the cost of $41,000 minus accumulated depreciation of $16,400 gives me a book value of $24,600. Now that's the number I will carry down with and start in year 2. At the beginning of year 2, the book value is this $24,600. So $24,600, I'll take 40% of that, and I'll get a depreciation expense of $9,840. So I had $16,400 in there. I added another $98,400. The balance in accumulated depreciation is $26,240. The cost minus the accumulated depreciation gives me a book value of $14,760. That's the $41,000 minus $26,240. This is the number I will carry down to year 3. When I did year 3, the book value was $14,760 times that same rate of 40%, which gives me depreciation expense of $59,004. Add that to my previous accumulated depreciation, and my new balance in there is $32,144, which means my book value goes down to $88,56. That's what I used to start year 4. $88,56 is the book value times 40% gives me depreciation expense of $35,042. Add that to my previous accumulated depreciation, and the balance there goes up to $35,686. The book value goes down to $53,14. Now, because I'm only depreciating this in year 5, I need the book value to be $1,000, and I need accumulated depreciation to be $40,000 at the end of year 5, because that's my I need these two to add up to the 41. I need to end with a book value. So in order to get the depreciation, the accumulated depreciation up to $40,000, that means the balance here has to be $43,14, which is just my previous book value minus what I want the book value to be. So that's just the $53,14 minus $1,000. And that's only because I'm only doing it for 5 years and I need to end at $1,000. All right, let's do, let's see, just ignore those little things. Let's do, these are the problems that are in the, in the practice sets, the practice demo problems. So that's what I'm going to use here to solve this one. So I have 2 problems here, I think, in a partial year, and then I'll end it on this one. So we have a plane. We bought a plane for $33.5 million. We expect to use it for 5 years or 4 million miles and have a residual value of 5.5. And they expect the plane to be flown 1.1 million miles during the first year. So we're going to use all 3 methods to do this one. So straight line. Oops, I have to put that back on. Sorry. Straight line. I don't want red. I think I still have red. Okay. Straight line will be the cost minus the residual value divided by the useful life. Useful life. So in this case, that's the cost is $33.5 million minus the residual value is 5.5 million divided by 5 years is the estimated useful life. I get depreciation expense of 5,600,000 per year depreciation expense. So the depreciable cost here is the 28 million divided by 5 years gives me 5.6 million per year if I'm doing straight line. If I'm doing units of production, first I take the cost minus the residual value divided by the estimated usage, and that will give me my my per unit depreciation. Per unit. So 33.5 minus 5,000,005 divided by, I'm expecting to use it for 4 million miles. Means my depreciation per unit is going to be $7 per mile. And then in year 1, I used it for 1.1 million miles. So I'll take the 1.1 million miles times $7 per mile, and I get 7,700,000 depreciation expense in year 1. Now, I'm going to run out of room here, so I copied the same thing over here on this slide. Just ignore that yellow mark. And so now we're going to do double declining, which will be cost minus accumulated depreciation, also known as the book value, times 2 times the straight line rate. So the straight line rate is 1 over 5 years, or 20%, and then I double that. So the cost is 33.5 minus the residual value, the accumulated depreciation, which in this case is 0 because I haven't done any yet, right? Times 2 times the straight line rate, which was 20%. So I've got 33.5 times 40% equals 13.4 is my depreciation expense in year 1. And then the last one asks us to do a little comparison here. So we can compare straight line, units of production, and double declining, and they're asking us for the book value. So we would take the cost minus the accumulated depreciation after year 1 would equal our book value. So the cost is the same in all of them, right? 33.5, 33.5, 33.5. The depreciation, well, let's see, here's this one, 13.4 was my depreciation expense, and therefore my accumulated depreciation under double declining, which gave me a book value of 20,100,000. And I had 5.6 and 7.7 million here. So 5, 6, 7, 6. And 7, 7. So the book value under straight line was 27.9 at the end of the first year. The book value under units of production was 25.8. And the book value under double declining, that accelerated method, which gives you a bigger tax break, is 20 million. And then this would be the basis in year 2 of double declining. That becomes the book value. So in year 2, I'd take 40% of of the 20,100. In straight line, the depreciation expense would be the 5.6 again, and in the units of production, it would be 7 times however many miles I flew the plane. So if you had the miles, you could figure out year 2. But the next problem does ask us to figure out year 2. So they're asking us to calculate the second year depreciation. Again, we've got a plane. This one cost $40 million. I'm going to use it for 8 years or 5 million miles and expect it to have a residual value of 5 million. And then it gives me the actual miles flown in year 1 and year 2. So we're going to calculate it, and then I'm going to take a break and cut this video off. Oh wait, I think I have one more quick one to show you. And then I'll do a second video for the disposing of the assets. So we're almost done, just hang in here a little bit. Straight line. Cost minus residual divided by the useful life. So in this case, that's 40 million is the cost of the plane. Residual value is 5 million. And it's supposed to have a useful life of 8 years. So that gives me 4,375,000 depreciation expense. And for straight line, that'll be year 1, year 2, year 3, all the way down. Units of production. Again, I'll take the cost minus the residual divided by the estimated usage to get that per unit rate. So in this case, that's 40 million minus the residual 5 million. So I'm going to take that 35 million and divide that by the estimated usage, which is 5 million miles. And I get a rate of $7 again, $7 per mile. So in year 1, I expected to fly at 1.2 million miles. I'll take that times 7, and I'll get depreciation expense of 8,400,000 in year 1. In year 2, I flew it or expect to fly for 1.4 million miles times $7 per mile gives me depreciation expense of 9,800,000 in year 2. So double declining. This is good so you can see it in the second year here. So double declining will be the cost minus the accumulated depreciation, or the book value, times 2 times the straight line rate. So double declining. The straight line rate would be 1 over 8 years this time, and 1 over 8 is 12.5% per year. So if I was doing it straight line, I would take 12.5% per year of the depreciable cost. So here, again, keep in mind you don't take the salvage value or the residual value off the top, right? Because we're just doing, book value here. So the cost is 40 million. Year 1. And in year 1, there's no accumulated depreciation yet. And I'll take that times 2 times the straight line rate. 12.5%. So I'm going to take 40,000 times 25%. And my depreciation in year 1 is $10 million. And in year 2, the cost will be 40. And now I have 10 million in accumulated depreciation times the 25%. So 30 million is the book value. times 25% gives me depreciation expense of $7,500,000 in year 2. And then the last part of the question here asks us to calculate the balance on accumulated depreciation at the end of the second year. So if we did straight line, units, and double, year 1, year 2, total. So let's just do double declining because we've got it right here. 10 million in year 1, 7.5 in year 2, so I've got 17.5 at the end of the second year, which means in the third year I would take the cost of 40 minus accumulated depreciation of 17.5 to get the new book value and take that times 25%. In, let's see, we had 8.4 and 9.8 here. 8.4, 9.8, which gives me total accumulated depreciation of 18.2. And in straight line, I take the same every year. So 4,375,000, 4,375,000. So at the end of the second year, I have a total of 8,750,000 in there. And the last thing I want to show you in depreciation is when you have to do a partial year. You just figure out like you would for a whole year and then take it times the number of months that you used it. And you often have to do this if you didn't buy it at the beginning of the year. You might take a partial year, or if you're selling it and you've used it for, say, 3 or 4 months, you have to update the depreciation before you calculate the gain or the loss. So that's when you do it. So in this example, we purchased it on September 30th, which really means we used it for October, November, and December. So we used it for 3 months of this year. We purchased it for 38. We expect it to have 4 years, a residual value of 2, and we're using straight line. So we calculate what it would be for a whole year using straight line, and then we just take that for 3 months. So the cost minus the residual divided by the useful life, that would be what 1 year's depreciation would be, and then I'm just going to take that times the number of months over 12. Or you could take it, divide it by 12 and take it times 3, however that makes sense to you. So the cost is 38, the residual is 2, and I'm expecting to use it for 4 years, so that would be 36 divided by 4, or 9,000 per year, times 3 over 12, or times 25%. So 9,000 times 25% would give me 2250. Would be 3 months worth. In year 2, so this will be year 1 since it's a partial year. In year 2, it'll be the whole 9,000. In year 3 and year 4 would be like that. Okay, so that's depreciation. I'm going to stop it here and try and post this video up, and then I'll come back and do when I discard an asset. Okay.